Welcome back, everybody. I would now like to introduce our panel moderator for this morning's session, Phil Morabito, the president of Pierpont Communications.
Thank you so much, and it's so great to be here today. I'm very excited about today's panel. If you want to talk finance, you want to talk to these guys. I'm going to introduce our panel today. We have two wonderful financiers. First, we have David Magdal, who served as president of Main Street Capital since November of 2018 and chief investment officer and senior managing director since 2011. Previously, he served as vice chairman from 2015 until November 2018. Magdal has served in other senior executive positions at Main Street since prior to the IPO in 2007. He's also served as senior managing director in other executive positions of several Main Street predecessor funds and entities which are now subsidiaries since 2002. Magdal joined Main Street Investment from the investment banking group of Lazar Affairs, and prior to Lazar, he managed a portfolio of private equity investments for the Mullen Group. Magdal began his career in the structured finance services group of JP Morgan Chase. Our next panelist is Taser Badar. Taser Badar is the founder and CEO of ZT Corporate. It's a private equity firm in Houston specializing in healthcare and automotive companies. An operationally oriented entrepreneur and investor, Taser built his company from a wealth management firm into a dynamic multi-million-dollar enterprise over the last 20 years. Having played a pivotal role in the firm's transition with investor return and community improvement at its core, his drive for operational excellence has led ZT Corporate to optimize its portfolio and inspire his team to continually innovate unique investment options. So let's bring in our panel, and I will start answering a couple of questions. Welcome, gentlemen.
Good morning.
Good morning.
Good morning. We're glad to have you. What we're going to do is we're going to ask some questions and then invite everyone to send in through the chat their questions. And we'll ask one panelist to lead the answer to the questions and then have the next panelists jump in when appropriate. So the first question, we'll start off with David. A lot of people, David, are comparing the impact of COVID-19 and what it's had on the market in the last financial crisis to 2008. Would you agree, or how would you describe today's market and the impact that COVID-19 has had on the market?
Yeah, thanks, Phil. Just a quick sound check, hoping you can hear me okay. So the difference between the 2008 and 2009 crisis, economic crisis, and what we're seeing today is the sudden nature of the pandemic. So back in 08, 09, it was really a focused financial crisis. It hit a lot of industries specifically initially, and then had a ripple effect throughout the economy. What we've seen now with the pandemic is it had really negative impacts in certain industries, certainly, but you had a lot of stimulus take place very quickly. There was great and sudden negative impact as far as unemployment and as far as the stock market. So it was just very unnerving in nature. People didn't know exactly what to do with it. So, as far as the impact across our portfolio and across the economy at large, I think that the first several weeks from March, or maybe 8 weeks to 12 weeks after it hit in March, was just trying to get a new sense of what the norm was going to be for the next year, and how long it was going to last, how long it was going to take to get settling and get feet firmly planted on the ground. So while it feels very similar in a lot of respects, the difference is there are some industries that have really excelled. People don't like to talk about it in the current environment. A lot of consumer behavior has changed. There's also been huge negative impact relative to unemployment and to the restaurant industry, as an example, and other facing industries that are obvious to us as observers in the economy. One of our jobs is looking at industries and figuring out and companies specifically where there's opportunity and how they can best position themselves in the current environment and going forward. So while it feels very similar today, we think it's a very different set of circumstances than we had back in 08, 09.
Okay, great. Taser, would you add anything to that? The differences between 2008 and so the COVID environment today?
I think David hit it spot on. I mean, I think I'd only add just to, for anyone who understands the fundamental, just to reiterate what he said in a different format, the fundamentals of the economy were very, very strong. In 08, 09, obviously, we know it was very different. So the fundamentals are very strong. I just want to add that in this COVID environment, I think for an investor to look into your company, for a bank to lend to you, it's really important to see how the management team fared during this time. And they're looking for some heroes here. What did they do? How did they handle things during this time? What ingenuity, what pivot did they make? I'm not trying to take away from the whole presentation today, but I know we're going to talk about that throughout the panel today. But those are the things I would say. But I agree, the fundamentals are really strong. There's a lot of cash on the sideline, and unlike before, there was no liquidity in the market in 2008, 2009.
Okay, great. Next question, and we'll ask David to lead off on this one. David, what opportunities does a dislocated market present for businesses, both for you and other companies that are watching here today?
Yeah, so it creates tremendous opportunity. It's a question of what you make of that opportunity. There's some instances where companies have been clearly negatively impacted. They're trying to get their sense of what to do, how to position their business in the current environment, and then for the opportunities that will come. It's all different depending on the industry segment. So those that have a plan and are looking forward, cutting costs in an environment where revenues have been really dramatically and negatively impacted is important, but also looking at the medium and longer term, not cutting too deep too early as far as human capital resources, pulling back on what otherwise would have been plans for the future. You have an acquisition strategy, making certain that you don't lose contact and you're keeping in touch with your pipeline of acquisitions. And of course, many companies don't look at acquisitions, but look at their normal organic growth and opportunities to open new offices or what have you. So sticking to the plan, but capitalizing in a way and making sure that you're communicating regularly, with great openness with your lenders or your equity partners is so important these days. So the dislocation is important to recognize and to be thoughtful about how you're putting yourself in a position for the long term, but also being very mindful of the disruption that's taking place in the short term. I think sometimes what happens is business leaders are so in the firefight that they don't lift up and look at what decisions they're making unintentionally in the medium term for the business. It's okay to protect the other employees and to let people go when things are tough, but it's also really important to keep loyal to those that have gotten you to where you're going to be and the great resources that you have, and lead by example. Nothing worse than having a disingenuous owner or manager that makes decisions that are really tough for everyone else, but doesn't live by their own decision making. So I'd say the dislocation in the market is the strong will survive and be tenacious. And we look at the managers of businesses, the CEOs, to make those decisions and empower them to be mindful of not just knee-jerking and making short-term decisions, but really in this moment of dislocation, others will be making those knee-jerk reactions and not allow themselves to be taken down that path.
Okay, great. And Taser, I know you know all about opportunities in this environment because ZT Motors just bought a very large car dealership in Houston. Can you talk a little bit about opportunities in dislocated situations?
Well, right now, I feel like I kind of prelude into, then again, my thought process throughout this panel is the market is really ripe for opportunities. I mean, I feel like in the healthcare business, the auto business, we see so much activity going on right now. And I agree with David, the strong survive, sticking to your plan. You're gonna get some, this is an opportunity, obviously, to those that on your team that can't basically make the cut at this time. Not to sound cold, they don't make it, but the ones that are loyal really rise to the top, and you're going to get a lot of talent pool to join your team. Hence, you can take on more. And in the healthcare space and auto space, we're seeing tremendous activity right now. The opportunity is very contrarian to what the March lows looked like, and we really stepped in and took advantage of that and got a lot of COVID pricing. And if I didn't close on, for example, that dealership in Houston, it would have retraded much higher. As a real example, we locked it in during the COVID right at the beginning.
Excellent. Great move on your part. Okay, moving on. Let's talk a little bit about mergers and acquisitions. What's the state of the current environment of mergers and acquisitions that you're both seeing? Why don't we start off with Taser on this one?
Well, the M&A activity, I've had real life examples of selling 3 companies to large private equity in the last 3 years. I'll give you an example, kind of dovetailing on the previous question. I was with the Ford group last week because they're one of the 8 dealerships that we bought, or 8 flags we bought at Ron Carter. Their buy-sell activity has quadrupled this year. Buy-sell is basically the term in the automobile industry for activity around a sell of an acquisition from a prospective buyer from a legacy owner. So the buy-sell activity has been really hot, and that's contrarian to what everyone thinks, especially in the South. So it's targeted markets. I think that has been very active in like I said, a lot of cash on the sideline, starving for yield right now. We're going to get yield right now. So people are looking to find yield and invest in private businesses. And if you have done well in the COVID environment, meaning your management team have a plan like David alluded to, and it's I wouldn't say easy, nothing's easy, but if you can prove your point, prove your thesis, and perfect your plan and show it proof of concept, you will find money and it will find you because it's starving for yield. On the healthcare side, we're seeing so much activity. Probably my investment bank group, Stifel, that sold our 3 companies, and another company, Tripletree, they have seen more activity during COVID this year, and I wouldn't have thought that until I met them, because we're building up our company, Altus, to build it up and obviously enter the market in a few years and to a point where someone else would take it. And that's our goal as well. So we're seeing a lot of activity, a lot of cash on the sideline, moving into companies. If you're narrow and deep in your thought process, into your plan, and not get distracted, the M&A activity will find you. They're starving for yield. I don't know if David agrees, but that's what we're seeing.
Yeah.
Okay, David,
Yeah, so we're seeing a lot of the similar things that you're seeing. To give a sense of what kind of our market, we've got about 180 investments. We're a public company. 70 of them have equity. In that portfolio, we see some of those companies looking at acquisitions, being opportunistic about people they've always wanted to talk to that might be in a local market or a competitor or a supplier that otherwise are struggling right now. And so that's what I'll fall into the category of more opportunistic as far as M&A activity. And then we see those businesses that are not capitalized with a lot of debt, may have a bump in the road, but they'll be fine the medium and long term. And for our model, what we see is we do both majority ownership transactions, where we'll buy the majority of the equity in a business along with a manager or an existing owner of the business for liquidity or for purposes of state diversification. But what we've seen more and more happen in this market is our portfolio is generally, in the past 2 to 3 years, has been a mix of both majority transactions and minority transactions, where we'll take a minority stake along with the existing management team or the owner of the business to provide them growth capital and some liquidity. We're seeing that portion of our business grow quite a bit. Why is that? Because good businesses that don't have to sell aren't going to, but they may have the same exact goals that they had otherwise. So they might need the liquidity. If you have an aging shareholders in their 60s, was waiting to sell, this was their plan. They were in the market, were getting ready to come to market this year. They still might want to finish those estate plans that they had put together. It's terribly important, and a focus on what's happening with the political elections and what will be the result and what will the tax implications be. So we've seen on the M&A environment is more creativity, more of a focus towards minority transactions for us, which is great. For our investment strategy, we want to find really motivated managers, people who know their businesses terribly well. We're relying on them to operate the business, and we're just looking for a stake where we can help them to capitalize on opportunities they may not have otherwise had the capital to find and seek in the marketplace, and then we allow them to do their job. So it's a question of where we fit. So I'd agree with Taser. There are some that are dislocated and are looking for capital because they're struggling. There are other opportunities for great companies that just need to transact for one reason or another. Just trying to figure out how you best position yourself and them for success going forward.
Yeah, so a follow-up question on that would be for our CEO audience. Say they're thinking about acquiring somebody. What would be like their first step? I mean, what would they do? Would they seek out their main competitors and just call them up, or what would you guys recommend that they do?
David, you want to take that, or I can? It's up to you.
Sure. No, go ahead, Taser.
Well, from my, I would assume the CEOs you're talking about, Phil, are ones that are pure operators, and they're looking to grow their business, and not a private equity investor. So on that basis, they're in the marketplace. They're on the ground, and their ear is to the street. So they understand what their competition looks like, who is a good target, how can they expand their base. See, there's 4 things I look at when I look at a business, and if it fits what they want to do. If they see a competitor or a geographic area or a business that they can acquire that has proof of concept that they think they can scale, that fits their narrow and deep model to grow to a certain earnings level, professionalize it, and set it up for a liquidity event 3 to 7 years down the line. That's our thesis. If they feel like they can find a business that has proof of concept but lacks professionalization, the capital to grow, that's the first step I would look at in looking at someone. And then obviously then the due diligence period, quality of earnings, and then all the steps that you need to go through to acquire. And acquisition is an art. It's a lot more fun than a startup. I think I've done the startup thing, and that's what got me where I am. But the acquisition thought process is a lot more creative. You kind of know where you are. You've matured as a businessman or businesswoman, I feel. And if you feel like you see a junior you that you could pick up at early stages, that has proof of concept, and put your narrow and deep management style into it, and maybe take some of their management pool with you. That's what I would look at first. Does it fit those 4 steps I was talking about? And if it does, how do we go in there and talk to those folks and network with those folks? Because they will trust you as an operator more than a private equity investor to start the conversation. That's how I feel.
David, anything to add?
As far as business owners that are looking maybe to transact and aren't sure how to do it, and they think that they want to sell, I think that's where the question's based. Is certainly talking to people already in your network. There are lots of capable strategic acquirers that have a natural reason to transact. So having those dialogues and doing it in a guarded way where you can kind of float the balloon out there and see whether you get takers is typically a way that people will initially seek to see if there are buyers for their businesses. For those that are looking to acquire, just being thoughtful about thinking about what's already inside your network, where your relationships already exist. It's amazing. Sometimes we were working with a company last week, and they're a good-sized, super regional player in their industry. Everyone knows their name, and they want to execute an acquisition strategy. So we were talking with what we call buy-side brokers, someone who comes in and helps them to identify players in their industry. And it's amazing how sometimes you say, let's start with the basics. Who did you compete with on your last bids? Whatever, depending on the business. Who do you view as those competitors? Can you do well by just looking at suppliers in your business? Pick up margin from acquiring suppliers. Who are they? Talk to your salespeople. Talk to your internal procurement folks. There are lots and lots of creative ideas that come through those discussions before you need to necessarily go out and seek an advisor. But again, some folks just don't know how to approach it. They're not seasoned, they're not comfortable enough. And then working with a good advisor, an investment banker or the like, can absolutely bring lots of creative ideas to bear.
All right, great. Next question, I'll ask David to lead off on this one. So we talked about M&A, and what would you categorize other reasons businesses are looking for capital today? What are some of the best uses of capital today for these businesses?
Right. So for us, we transact for all sorts of reasons. Sometimes it's partnership divorces. Two partners who started a business 30 years ago, and now one wants to play golf more, and the other one doesn't have any hobbies. That's a good reason to transact. One partner buying out another. Maybe it's a plant expansion or it's a new market expansion. I'd say at the most, for us, the most credible reasons are ones that are easily understandable and align interests. So our thesis, we've done hundreds of transactions over the time that I've been at Main Street, and the ones that have consistently performed the best have two leading features. One is the partner that we pick. It's the individual and team of folks at the company who are driving the results. It's very rarely is it about a specific industry that we've called wrong. We invest through the cycle. We're not trying to time things, so we already anticipate some ups and downs. We do lots of sensitivity tests around it, but it's about the individuals. The second is alignment of interests. We want to make our money when the teams are making money. We don't want it to be a disproportionate. You get 1 cent for every $3,000 we make. We want them to really, benefit from the growth channel that we're pursuing together. So there might be partnership divorces, there might be estate planning, but at the end of the day, the most important thing is the business, and the business is what we're investing in. The people drive the business, but you got to make sure that the business has the opportunity to succeed. That means not having too much debt, an appropriate amount of equity, and having the opportunity to capitalize on things happening in their industry that others might not be seeing or might not be tenaciously going after. And we've seen some really remarkable folks that we've partnered with over time see things that others in the industry just don't see and get that first mover advantage. When that happens, we see great margins and great differentiation. And then to the extent in our business, like Tazir's, you have entrepreneurs that want to have a second bite of the apple and want to sell again down the road. Having those kind of opportunity sets and be able to talk towards growth is important. And by the way, we also work with businesses that are just, that don't have huge growth trajectories. You can make money either way as long as you capitalize it properly and have the right set of expectations.
Okay, great. Taser, how about you? What are you seeing people need capital for?
Well, I mean, I guess the question, the capital, I think the red flag, like what would they look for? I think David said it perfectly. I look at balance sheets. I look at things. I mean, the intent. When I look at someone with their, when I look at a red flag of somebody, or I look at things, I agree that the partner, the aligned interest, what they're looking to do, their intent, their character, what's their previous history. If they're looking to cash out for the right, enroll their equity and be aligned interest, that's the alignment on both sides, the investor side and the operator side. However, what I've seen a few times is a lot of people have balance sheet problems and they try to go get capital, refinance, and basically just kind of cover up their problems. When I look at that, I get turned off. But when I see someone wanting to grow, again, like I said earlier, that's narrow and deep in their plan, I feel as though if there's aligned interest and they're willing to put their skin in the game again with us as an investor, I feel as that to me is huge, and that to me shows their character for the company. Character to me is everything, and there's ways that you can see the character within the balance sheet and the numbers. I mean, it really shows vividly in my opinion.
Yeah. So one last thing to add is just that we focus a lot on what the reason is for transacting, and sometimes one of the challenges with advisors is they give advice to maximize value in a transaction. So that typically means that you're trying to sell more towards the windshield than the rearview mirror. So selling a story towards growth of one kind or another. And that's great. We love seeing it. But then be really smart and tenacious and thoughtful about what you're presenting. Because so often we hear about acquisition strategies, or we hear about a new product introduction. And when you really dig into the details, no discussions have been had. There are no targets out there in the acquisition fronts, or on the new products. They haven't really tested it. They haven't seen what it costs to produce it, or the like. It's just more theoretical. And it's the worst combination is when we see that with a 35-year-old who's looking to get 100% cash out of the business. Because if the opportunity set is so great in the windshield, then why are they looking to cash out for the majority of their business today? So it's being genuine and really understanding the plan that you're presenting, because if it's believable, credible, and you've done the work, you're going to find the capital. But if you're kind of selling more of a story, investors are smart. And they will likely be asking questions that are going to be uncomfortable answering if you haven't done your work.
Very well said.
Excellent. Yeah, good point. All right, so now I'm going to shift the focus to really connect with our entrepreneurial audience that we have and talk about the entrepreneurial spirit you guys have. So we'll start this one off with Taser. So Taser is the CEO leader. How has your business evolved over the last 10 years? And what steps should we be taking to ensure resilient, long-term success for our businesses?
Well, I think in my career as an entrepreneur, I was extremely, and I still am hands-on at a different level. Every entrepreneur starts off from humble beginnings, mom and pop style. In my culture, my background as a business, I think David alluded to earlier, if your business is doing great, why would you sell it? But there's a life cycle of a business that you need to partner with someone down the road to take it to the next level. And entrepreneurs, they have a very hard time letting go of their baby. And I had a hard time letting go of a few things as well. And I've made mistakes along that line. I had an imaging business at one time, imaging CT MRI business for years within our hospitals, that it was a separate standalone unit. And we were getting $3,000 to $4,000 in MRI 15 years ago. And many times I was asked, well, why don't you package that and sell it? And reimbursements drop, the risk. As an entrepreneur, a lot of times we don't see things, the risk down the road. What's the sensitivity test? We believe so much it'll last forever. So we put, and also in my business, just to touch on it, everyone did everything at the beginning. Like my CFO was a CFO of so many different entities that we had. Now we have, as we've evolved, it's more of a corporate structure without losing the family entrepreneurial style of a public company. Maybe I'm not putting down public company as an example. We're much more family in our company. We didn't lose that who we are as people, as how open we are with our employees. But we do have different divisional directors, presidents who are narrow and deep in their focus. There's no cross-pollination. They focus on what they do. And our business has evolved much more as we've adjusted and pivoted over the years, because as the environment changes within certain sectors, you have to have someone that does all they do and all they know, and having that experience. Where at one time at ZT, everyone did everything, and balls would drop in certain areas. As we did one great in one area, another area would drop because the focus would be off of it. And that's a true entrepreneur startup. And like I said earlier, we're more about scaling and acquiring management teams and going forward and adding them to our business. So our business has completely changed into more of a corporate structure, again, without losing that and losing the family style that we are with our employees. I think that's our competitive advantage to have kind of a hybrid approach. However, I've made mistakes, like I said, in the imaging business and other healthcare businesses when, for a really good example, when they all go through cycles, and at the top of the cycle, we didn't read that at the beginning. We thought it would last forever. And if I had a president of that division, that's all they knew, they probably would have asked me to pivot to something else and package it and move on and get a partner to help us, figure out how to do something else with it, instead of just sitting on it and watching $3,000 MRIs go to $300 MRI. So that's what happened. So those things, you learn from those mistakes, and mistakes make you better.
Thank you. David, how about you? What's involved with you?
Yeah, I think it was well said that so we started with 5 partners and a couple in support staff back in 2002. And we had, revisionist history would tell you we were a $100 million fund. It was 81. It was, we fought to get to 81. Today we're 4 billion, just over 4 billion. And the challenges are different today than they were back then. It's more about, an institution having a platform, but we stayed true to our original thesis, which is partnering with entrepreneurs, making sure that they have the resources they need, knowing where our interests start and stop, and not trying to overstep. Where if a manager is really looking for, an owner of a business is really looking for deep expertise on how you source something in mainland China in a very specific product category, it's not us. We're very good at strategic direction. We're very good at analytics. We're very good at supporting businesses from a professionalization basis. But we also want to make sure that we keep kind of our culture the same as it was when we started, which is to be good folks to work with, honest as far as our ethos and the way that we communicate, and not having airs about us. And that's where the challenges, evolve to, not challenges, opportunities, but we need to continue to keep that same culture as we grow. And I heard Meg Whitman speak a couple of years ago, CEO of eBay, and she was growing by 200% her headcount per month for years. And what she said, which was really interesting, is when you're in growth mode, or as you change as a company, it doesn't even have to be ultra high growth. It's having the right person in the right seat at the right time. So it's, as you're hiring, it's making sure that as the company evolves, as it changes, as your products might change, or you're entering new markets, making sure that you're constantly looking at the people you have, and are they the right people for that seat at that time.
Okay, great. Thank you. We're starting to have a bunch of questions to come in, and we're going to need to end in about 10 minutes. So I'm going to start asking questions from the audience. First question, during the market environment, what are the top reasons businesses are looking for capital? Is it for survival, growth, acquisition? Are some companies needing capital just to survive and exist? Have you seen some of that? Or most people looking for money to grow or acquire somebody? David, you want to kick that one off?
Yeah, so there's definitely some survival characteristics coming out relative to a need for capital. Unfortunately, the worst time to come looking for capital is when you're desperate and you absolutely need it for survival. There is certainly some of that in the marketplace. We're also seeing businesses that are coming and sticking to their knitting and saying, gee, COVID has had an impact, and maybe it's been negative, maybe it's been positive, but they still have a plan they want to execute on, and for whatever reason they're coming to us for would have been the same reason pre-COVID as it is today. Our biggest challenge is seeking or sorting through the companies that we think have got opportunity sets that will exist well beyond when COVID is behind us. I know it seems like COVID will be with us forever. It won't be. So really understanding the business and giving it the opportunity and the capital it needs to do well today, but well beyond COVID is what we're looking for. And the problem is there's a lot of noise. So businesses are coming and they're having to adjust their profitability. And what does that mean? And what's credible and what's not credible? So businesses are coming for 2 big picture bucket items. One is for what they would have come for without COVID, and then within the COVID kind of cloud, it's either for rescue capital or to be opportunistic within the COVID world and go to acquire or grow somewhere where they see opportunity sets.
I
Taser?
think that the add back, like as far as the COVID and I think that there's certain industries that are obviously looking for survival. I mean, you look at the airline industry today, they're getting a pop, for example, because of the stimulus talk. Yesterday it got declined because President Trump said what he said. And then today, because they're looking for survival, right? They're burning through capital, trying to get to the other side of this. And then you see folks like in healthcare and auto side, which is our sectors, we're for the ones that are doing well, we're looking to grow and take out those elderly clients now, or the ones without a succession plan to grow, we're seeing a lot of that as well. So there is both sides. I think there is the survival aspect. If a company believes in your, like everyone believes, like David said, the COVID will end soon. I hope it's sooner than later. And if they believe in your sector and what you're doing and how you ran a business pre-COVID, they would add back those COVID losses and look at you pre-COVID and get in value at that time. You could probably negotiate. Yes, there's a desperation part of it, but there's true hard assets. Like I know an investment firm, and I think David would know that one of this group too, out of New York, that bought all these planes, for example, from these airlines and leased it back to them because they needed cash, at very high rates just to survive. They obviously believed in the credit of that customer, of that airline, to do so, to get on the other side. So there's different levers to pull, different ways to do it. But I do believe there's both sides of it, and capital is looking for, that's a really big play for a private equity firm, big, huge returns, that type of situation. And then someone's looking for a more stable type of return, that someone who's doing well in the COVID environment, to put money to work, to get more of a, so they kind of a blended yield, kind of a portfolio approach that I've seen investment firms do.
Okay, thank you. Next question is, what kind of target margins are happening currently? And what kind of margins do you guys respect or look for in companies today in the COVID environment? Are you a little more lenient about looking at margins, or how do you feel about that? Who wants to kick that off? David?
Oh, good.
Go ahead, Taser. Looks like you're ready.
I feel like it's there's different sectors have different margin. You can't compare a fast food restaurant to a luxury hotel chain. It's just different. You have to look at how normalization of the asset was pre-COVID, and how they were doing at that time, and how you feel, like I said earlier, how they look on the other side of it. So it's all about how they did pre-COVID and during COVID, how close to the margins they were, how close they were to netting those type of results they did pre-COVID, in my opinion. But it's that margin question it's really focused on different sectors, and it's different for every sector and what you're looking, and because of different, like our healthcare business, our margins are very high. In our auto business, margins are not. So it really depends on how you compare to your marketplace. In our auto industry, we have what's called the NEC software, that we compare ourselves to the benchmark in the top 5% every year. That's how we look at how our dealerships are doing versus the top 5%. And I'm looking to invest in those types of management teams that can be in the cream. And that's how I look at things. So different margins will show up within different sectors, and how different margins are approached. In my opinion, they're not universal across the board. It's sector by sector.
David, comments on margin?
Nothing to really add. I just say that, I think the question maybe is trying to hone in on margins in the COVID world versus pre and post. And I would just say that it depends very much on the industry. We'd expect that margins get impacted by, labor costs, and labor costs have been, depending on the industry segment, very much impacted by COVID. Even if you had a business that was defined as a critical business and you worked throughout COVID, you probably had some disruptions relative to people getting sick or being nervous about coming in or not being as efficient. So I'd say that, we're looking at kind of what was happening pre-COVID as our best mark for what we'd expect in the medium term for future. And then depending on the industry segment, we'll adjust depending on the, on the results historically and what we think the lasting impact will be on the business.
Okay, great. All right, in the last few minutes, because you're both clients of mine, and I know you're both very, very successful in what you both invest in, I'd like each of you to just talk a little bit about some of your successes, companies you've invested in that you've seen become successful. And maybe recently, or maybe in the last few years, or something like that. Can either of you comment on that?
Go ahead, Taser.
I can highlight one of our companies I'm really proud of. We took being in the healthcare space, we were a startup, and I actually, believe it or not, and was in the surgery center scheduling patients and all that. And I met a couple of entrepreneurs that were selling me sleep equipment at one time, and they got into what's called the infusion business. And we looked at, they needed capital, they needed credit, and we weren't truly a investor at that time. We just wanted to get into that business. We thought the margins were very good. We thought the growth potential was scalable, and we got involved at a very early stage. We bought that company, 51% of that company, for $3 million, and sold that company after helping scale it, give credit. We got some doctors involved. We had a doctor base, and they replicated that in about 7 or 8 states, and we sold that deal to Wad Capital, which is a big group out of Chicago, for over $100 million, and that was really a nice return. And then that was really a big honor, I think, that they took our management team. So they're now up, like David mentioned earlier, up for another bite at the apple, much larger bite, I think, because now they're in 35 states, and they have a great partner behind us. And to me, those are great stories, not only for our investors that invested in it, the low valuation, and we helped grow that operationally and financially, but to see those guys who sold sleep equipment and just came and waited for us in the lobby for hours and now doing extremely well, and to be part of a sophisticated finance world, or just being, guys that just were, you see in the movies that, who come from nothing and become something. It's just amazing how much they've grown. And we have a few more stories like that, but I'm very proud of those two gentlemen.
Great.
Yeah, so
David, a
for
Main
us-
Street company?
Yeah, so for us, I'll highlight one, but really the most exciting part of our job is to invest in a company and see the folks who have been in it for years. And very typically that's not about a story about one individual, but it's about a team. See them able to succeed and take opportunity, and very frequently, get equity for the first time. So it might be a manager who's run a business for the last 20 years, or been one of the key people on the senior management team for an extended period of time, and let them, get an opportunity to put their fingerprints, serve on the board, interact with us, have expansion capital where they otherwise wouldn't have had it. It's very typical for us to work with a company where it might have an aging shareholder, and it's natural as people get older as business owners to want to maximize the amount of distributions they're taking out of a business and not to want to invest back in. Well, that next layer of management, whether they're younger or not, without getting the benefits of the distributions, they really want to have the capital available to do certain things in a business. And that's what's exciting to us, is to be able to hear a plan about where the opportunities are, whether it's in manufacturing, distribution, business service, software. It almost doesn't matter. It's just being able to capitalize on opportunity sets. One example that I'd highlight is a company we invested in about 4 years ago that was a division of a public company. And what was interesting about it was that the managers of that business had options in the parent company, but not specifically in that business unit. They were not core to the rest of the company. So the company, the owner was taking cash out as it generated cash. They weren't allowing the company to reinvest in its operations. They wouldn't let them hire. I mean, this is a company that had, a small employee base relative to thousands, excuse me, at the parent, and they literally had to go to the COO in order to make a single hire decision. So it was just being really managed for cash. When we carved out the company and worked with them to establish their own standalone entity, the company's flourished. They've done multiple acquisitions. They've expanded their product offering, their CapEx budget's up, and the company's tripled its profitability. So it's very exciting to see the managers of those businesses personally benefit from our type of capital, and for the business to be able to flourish and do things it wasn't able to do before.
Well, great. Well, I want to thank you both for some wonderful information. We could talk all day, with the knowledge you both have in the finance area. And we really, really appreciate the time that you spend with us. I'm going to turn it back over to Christina, our host, and wish everybody a great rest of the day and wish both of you a great week. Thank you.
Great.
Thank
Thanks,
you.
Phil.
Thank you.